Hi everyone, I'm Lee. Welcome to my channel. Project 120 is a challenge I put to myself to make 120,000 in a year on top of salary by various means. Trading, investing is one of them. I'll be showcasing two of my trading accounts for 12 months or in 52 updates. We'll see how we do. Let's delve right into it. This is the screenshot from the previous week on Tiger Trading account. The market value was 14,700. Fast forward to this week, the market value is 14,800. The value hasn't changed much, but I've made some changes to my holdings. I bought 10 core contracts on Baidu again with a new strike price of 115 Hong Kong dollars. If you recall, the ones I closed had a strike price of 110 Hong Kong dollars. I got the feeling that this bull run of Chinese internet stocks isn't over yet, and buying new contracts gives me the feeling that I'm starting a new trade, knowing that the last trade was profitable. I've also further reduced my Tencent position to just one core contract. I haven't decided whether I want to close my position on Tencent completely and start new ones when I feel the time is right, or to hang on to this core contract till expiration and let the brokerage house auto-exercise the option since I'm deep in the money. If I go with the second choice, I'll be holding 100 shares of Tencent stock at a cost of 300 Hong Kong dollars per share. Technically, given that I paid 2,000 Hong Kong dollars for that one contract, my cost per share will be 320 Hong Kong dollars. The benefit of doing that is that I can continue to ride the upward wave and potentially make more profit, as well as selling covered call option on Tencent, which is something I want to showcase as an option trading strategy to you guys. Another reason for holding the in-the-money call option till expiration is that when a call option is deep in the money, which means the market price is way higher than its strike price, the market liquidity becomes quite bad. So bad that sometimes you can only sell the option at its intrinsic value. For those who want to know what intrinsic value is, please click the link in the upper right corner or down below at the video description section to watch my last video. In my case, the strike price of my call option is 300 Hong Kong dollars. The market price of Tencent stock is at 371.6. So the price of the call option is at least 71.6 Hong Kong dollars, plus whatever time value there is left. I thought I might as well take in the underlying stock. It's not a bad idea to hold Tencent stock for medium to long term anyway. Moving on to the other account, Moomoo Singapore. This is the screenshot from the previous week. The market value was 10,500. Fast forward to this week, the market value stands at 13,700 now. I mentioned that I bought some Tesla put options in the last video. What happened was when Tesla released its quarterly report, the result was really bad, if you remember. Instead of its stock price taking a hit, it rebounded dramatically for a few days from its low of $140 per share all the way to $190 per share, which seemed like a short squeeze rather than a normal rebound after a deep correction. But the problem with short squeeze is that after the bears are heavily wounded or dead, the winning side need to cash in for profit, which means they need to sell to lock in the gain. There isn't really any good news for Tesla in the short term, barring from the promises Elon Musk made at the earnings call. If you follow Tesla or Elon for some time, you know that his promises are often delivered quite late, if delivered at all. To be clear, I'm not a Tesla bear. On the contrary, I've always wanted to own Tesla shares at a reasonable price, and I'm still waiting. If there's anything I learned in the years of investing, you can definitely pay too much for a good company. It's important to invest in good companies if you are a long-term investor. But it's even more important to buy a good company's share at a reasonable price. Anyway, coming back to my put option on Tesla, I bought 5 put contracts with a strike price of 160, expiring at the end of June, when Tesla's share price was $190. 1 week later, the share price plummeted as I wished, and I sold 4 put contracts with a profit of $2,200. I'm still holding 1 put contract on Tesla. I'll probably close it next week. Today I spent quite a bit of time talking about my trades, so I'll just quickly explain some of the common terminologies in option trading for the benefit of whoever isn't familiar with them already. I think this will probably help me being understood better in my future videos. So the terms we're going to cover today are as follows. What is long and short? What's the difference between option price and option premium? What's time value or extrinsic value? What is time decay? What is volatility and implied volatility? Having a long position in a stock usually means that you own the stock. Investors maintaining long positions are expecting the stock will rise in value in the future, or else why would you buy the stock in the first place? The opposite of a long position is a short position. A short position is generally the sale of a stock you do not own. But shorting a stock is an investment strategy that warrants a separate discussion. We'll talk about it some other day. The alternative expression that carries similar meaning is that you are bullish or bearish on a stock. In option trading, if you own a call option, you can say that you are bullish on the underlying stock. Conversely, if you have a put option, you are bearish on the underlying stock. Time value and extrinsic value. I explained what time value is in my previous video. Time value and extrinsic value are the same thing. But time decay is a different concept. If all other elements remain the same, the time decay causes an option to lose its time value or extrinsic value as it approaches its expiration date. Volatility is simply the extent of the stock price movement, either upwards or downwards, in a given period of time. Implied volatility is what the market is implying the volatility of the stock will be in the future based on price changes in an option. It's worth noting that implied volatility is not based on historic volatility. Based on news or rumors in the marketplace, let's say certain major events such as quarterly report release, merger acquisitions, lawsuit outcome, and etc. People will change their trading patterns on certain options. The demand and supply dynamics will start to change. That drives the price of those options up or down, independent of stock price movement. Remember, implied volatility only affects the option's time value. In other words, the reason only the option's time value will change is because of changes in the perceived potential range of future price movement on the stock. Alright, I hope that's helpful. Again, thank you so much for watching. Until next time.